So welcome to the School of Business's March Thought Leader webinar. I'll begin by introducing Jeff Neumeister. Jeff Neumeister is a well-educated and experienced forensic expert and consultant in accounting and financial advisory services. Small organizations, startups, holding entities, high net worth individuals, and middle market companies directly and through their retained counsel have relied upon Jeff to identify problems, uncover frauds, improve efficiencies, and to initiate and defend against litigation. Over his 22 years of professional experience, he has worked in firms ranging in size from large international entities to smaller regional practices. Jeff has been designated as an expert in multiple cases and has provided valuable deposition testimony for his clients. He has provided litigation advisory services to clients spanning a breadth of industries, including construction, entertainment, healthcare, investments, information technology, professional services, retail, oil and gas, real estate, education, food and beverage, transportation, pharmaceutical, and manufacturing. Jeff has provided business valuations for litigation and non-litigation purposes. Jeff has also managed the financial due diligence process for both buy and sell transactions. Through the use of sophisticated analytic solutions, investigative techniques, and an understanding of accounting, he has found effective solutions for a range of clients' problems, including those related to tax strategies, operational efficiencies, and internal controls. Outside of his time servicing clients, Jeff facilitates the professional development of future and current accountants as an adjunct professor and coordinator of the accounting department at Woodbury University. In his free time, he also enjoys participating in distance events, such as marathons and triathlons. I now welcome Jeff to present.
Thank you very much. Welcome, everyone. One thing I am not an expert in is trying to remedy a webcam issue in a short time window. It was working fine this morning, and something changed between then and now. But anyways, I'm glad you're all here. Thank you very much. If you were here last year, the same series, it's the same kind of format, but now just kind of talking about the changes that are occurring in 2025. Right? I already got to my background, lots of letters and words and stuff. Point being, I've been in the industry for a while at this point. Most of it has been in the forensic space. But one thing, for those that don't know forensic accounting, it's kind of the investigative aspect area of accounting. And in the courtroom and doing expert witnessing, ultimately, you end up having to become an expert in a lot of different areas and subtopics of accounting, tax, and finance, right? So you become relegated at becoming an expert at things you're not expert in a short window, except for IT. Here's a short agenda of some of the things that we're going to run through, depending on timing and the nature and volume of questions. I might skim over a couple of these points. First, I'm going to talk a little about due dates, which have changed for us in LA County, of course. Audit selection, what it means to be audited. Right? Some changes that are taking effect this year. Reporting digital assets, i.e. cryptocurrencies. Some takeaway tax strategies, and just reaffirming a key takeaway here that has its own bullet point rather than being part of number 5, which is always to consult a professional. And that's just not accounting and tax stuff. That's really on anything, right? First, on the due dates. So normally speaking, the personal tax returns, or 1040s, are due on the 15th day of the 4th month, or April 15th. Exception to that will be if April 15th, for example, falls on a weekend, then it's just pushed to the next business day. In instances where there is an emergency declaration, like what we had with the fires in January this year, a lot of times there's additional time to file. In this case, for residents of LA County, so if you have a business or personal residence in Los Angeles County, you're automatically extended to October 15th. Now, that's not just for the federal return, it's also for the state return to the Franchise Tax Board. And that is also applies towards tax payments. right? So if someone had, let's say, a franchise fee due in June of this year, it gets pushed back to October, right? So it's a nice little reprieve. Definitely doesn't offset the devastation we experienced here at all, right? But at least it kind of takes away the pressure of, oh my gosh, I have to file all my business returns and my personal return like now. For employed individuals, there's some other filings that precede their personal return. W-2s and 1099s. Those are supposed to go out by the end of January each year to the recipients. So our W-2s is something that an organization would issue to an employee. 1099, it's something that's issued to an independent contractor or a business or another entity that is set to receive such documents. Now, this doesn't come up so much with folks that just report off W-2s, but more so self-employed folks that have maybe a sole proprietorship. There is a common misperception that the amount you report to the taxing authority is based upon the 1099s received, right? So if a customer gives somebody a 1099 for $10,000, that's what you report, $10,000, even if maybe they actually paid you 30. Right? 1099s are really just a stopgap to help ensure, or at least mitigate the chance of self-employed folks from underreporting. Right? But ultimately, what is actually supposed to be reported is what was actually received, regardless of what a 1099 shows. Right? And this comes up all the time with a lot of vendors we work with on behalf of our clients, and even for some of our clients. We have to remind them it doesn't matter if someone doesn't give you a 1099 and they're supposed to. That does not mean you don't report that income. Still have to report it, 1099 or not. Right? So for self-employed individuals, it's imperative to maintain some meaningful books and records, right? Tracking of income versus expenses, and to not over rely on tax documents like 1099s. Now, 1099s are really good for help reconciling, making sure what you show in your own records matches what other people think they gave you, right? But they shouldn't be the sole source of making that determination. Now, what happens when let's say someone doesn't report the same thing that shows up on a 1099? This kind of goes to point item B on this screen right here on this slide. Right. So when someone receives a 1099, go back to that prior example, $10,000, but their customer paid them $30,000. Right? So now there's going to be a mismatch. So if the self-employed person reports 10,000, but the person that paid them reports 30,000, right, then that will usually automatically trigger an alert on the taxing authority side, like, whoa, something's not right here, right? We have two individuals or two entities that are reporting information that doesn't match up, that should match up exactly. Right? And that's one of the whole points of 1099s, is to help ensure that people are properly filing stuff. So the person that's issuing the 1099 is incentivized to properly report what they paid you, because if they want to be able to take that as an expense deduction, they need to issue the 1099. And that again helps. It's a way for taxing authorities to help build in some degree of self-regulation, self-enforcement when it comes to proper reporting. Now, there's some other same logic applies to like W-2s, right? Someone receives a W-2 for $50,000, but then on their tax return they don't report it at all, or report something less than $50,000. That will trigger an alert. Right? If they over-report, that would also trigger an alert, but there isn't concern about additional taxes or penalties paid. Right? In that case, the IRS would say, "Hey, like you reported 80,000 of W-2 income, but we only see 50,000. right? Therefore, you overpaid your taxes. Here's a refund. Now, funny enough, their systems don't seem to be as quick to catch those kind of errors when it's not in their favor. Surprise, surprise, but it does happen. Some other ways audit can result, aside from information mismatching, is if there's issues related to audits or examinations of related parties. Let's say, for instance, you're in business with a partner, and so you're 50-50 owners of a PR firm, and your business partner gets a love letter from the IRS, says, hey, you're being selected randomly for an audit. And during the course of that audit, they find that some of the stuff that's being reported from the business may not be entirely correct. Because they're related to you via the business, there's an increased chance that you can also be selected for such an audit, right? Because your business partner is on audit. It's not uncommon for those audits to expand in scope to other people, related businesses, or even other tax years. There's other things that can help increase the likelihood of an audit. For example, not properly answering the questions on a 1040, right? One of them currently, one of the big ones, is the digital currency box, right? Where people are explicitly asked, hey, have you done any sort of transactions related to cryptocurrency, more or less, right? And if someone says no, but then the IRS receives records from Robinhood or Coinbase or Binance.us or somebody else that shows that you were engaged in activity in that space, that can also result in alert and increase the chances of an audit. Now, when we are remitting information to the government, again, I'm using that term broadly. So when I say government, I'm referring to not just the IRS, not just the Franchise Tax Board, but really all taxing authorities, right? And every state pretty much has their own version of the Franchise Tax Board, or like a mini version of the IRS, right? They all kind of operate in a similar fashion, although they're completely different bureaucracies, right? So they might have different systems, they might have different audit methodologies, but they're all geared towards the same thing, which is ensuring people are properly reporting, right, and paying their taxes. And to the extent that they're not, to audit those individuals to recoup underreported taxes. So when we report information to the taxing authorities, aside from the reports that we're relying on, like W-2s and 1099s, there's other things that their systems will do. In this case, the IRS, their DIF system, they have algorithms, programs that help identify things that are more likely than not could be indicia of underreporting, right? Underreporting taxable income. I'll give you an example. And I've seen this many times over, unfortunately, where a client comes on board, and one of our standard operating procedures is to, if they're a tax client, right, is to get copies of their prior year tax returns, usually 2 or 3 years prior. And looking at those prior returns, really just to kind of get a sense of, how they file, what forms they typically are filing with, what kind of a tax exposure they're looking at, see if there's maybe some opportunities for tax saving strategies and stuff. And also it's a way for us to KYC, know your client, and assess the risk of working with a potential client. So one thing that comes up more often than it really should with some self-employed folks, whether it's a sole proprietorship or maybe a single member LLC, is you go and look at their profit and loss statement on the tax return, which is a Schedule C. It's part of the 1040. And you look through their list of expenses, and you notice round numbers, round number after round number after round number. So for example, I've seen Schedule Cs before where they're taking or claiming a deduction for 20,000 in rent, 15,000 in office expense, 5,000 in insurance, right? Just round numbers, right? Now, how many of us, if any of us ever went through the exercise of analyzing, let's say, our own bank statement or credit card statement for an entire year, if you added up all the expenses, say to Amazon or Office Depot or Vons or Kroger, and add up all those expenses, what is the likelihood that the aggregation of all those will result in a round number to the nearest thousand? Pretty low. So the fact that if that happens multiple times over for different expense categories on a Schedule C, that's an example of something that the computer program or the diff system with like the IRS will flag, like, whoa, this is statistically improbable that this would be occurring. Right? And keep in mind, they also have the advantage of comparing the returns from individuals, taxpayers, and businesses to other taxpayers and businesses that are in the same area geographically or the same industry or job function, right? Because usually, again, with a larger population, they start to identify certain patterns, right? Or certain ratios that are pretty common for certain regions of the country or certain business industries. Right? And so the system is a way of initially screening returns to kind of pre-select things for potential audit. Now, before it's actually flagged for an official audit, they always have a trained auditor look through it just to make sure maybe the diff system didn't incorrectly flag something, right? But more often than not, if the system is flagging things, there's a really good chance it might result in a love letter later on. Now, there's a couple other ways that a return could be selected or flagged for an audit, aside from related audits, which I referred to before. Also referrals. So there's actually a form out there that any of us could fill out to essentially call out somebody for tax evasion. Right? Now, using that just for personal vengeance purposes isn't going to help anyone, and they understand that there's enough of those that come in that are really just for vengeance purposes that really aren't founded on any sort of meaningful foundation. And they have ways of filtering through those, right? But if you know somebody, family member, friend, business partner, former business partner, a customer, a vendor, is absolutely underreporting their taxes, there is a form that can be filled out to alert the IRS or other taxing agencies, right? And assuming it is founded on some meaningful information and not just say, I think this person's underreporting taxes, there's a decent chance it'll be pre-selected for further screening by a trained auditor, and it could result in an audit. So moving past audits, let's talk a little bit about some of the changes happening now. The biggest change happening in 2025 is the sunsetting or potential sunsetting of a lot of the TCJA things that happened in 2017. So if we think back, several years ago, there's the Trump tax law changes, or the TCJA, Tax Cuts and Jobs Act, in 2017. Took effect in 2018, and there's a slew of things it did, right? Some of them I'm going to mention here, but I'm not going to mention all of them. One of them was it capped the value of that mortgage interest can be deducted on a Schedule A, right? So anybody that's a homeowner, or yourself or someone you know, there's a limit to how much mortgage interest they could deduct. It was $1 million. So property values up to $1 million. The TCJA capped it at $750,000, right? So in places like California or New York, or the places there's high property values, a lot of people had felt that, right? They would normally be able to take a larger expense as itemized deduction than now, right? Now that is set to sunset, and by sunset it means go away. the end of this year. All that is subject to change, though. We'll see what happens with Congress and the current administration, what TCGA things that they decide to extend past 2025 and or change. Another big one, and this is similar to the mortgage one, is the SALT cap of 10,000. So SALT is a lovely little acronym accountants use for state and local taxes. So it could be things like state income tax, it could be property taxes. That's usually one of the bigger ones. Okay? It used to be where you could deduct that as itemized deduction. So again, on your Schedule A, and there wasn't a cap. So in places like, again, California and New York, where there's high property values, property taxes are usually pretty significant. Right? I've had clients where their property taxes run 50, 60, 70,000 a year and more, right? Again, not super uncommon in places like California. And all of a sudden now this tax law change puts the cap at 10. So if someone used to be able to take, let's say, 50,000, but now they can only deduct 10,000, that's a loss of 40,000 in deductions. Right? Now put dollars on that. Let's just say that they're paying 30% taxes. It's $12,000 of extra tax they have to pay now. $12,000 just from that one change, barring no other changes in their income or the way they live their life. When that took into account, of course, that was a big hit in places like California. A lot of states, including California, came up with workarounds for that SALT cap so that certain individuals could still enjoy the benefits of a deduction that exceeds that 10,000. And it's in California, it's called PTE. It's a pass-through elective tax, but I'm not going to get into it in detail here, but essentially if someone had a business, a pass-through entity, the business could make a payment to the state so that it could get a deduction on behalf of the owners that essentially kind of circumvents or is like a loophole around the 10,000, right? So before they used to be able to take 10,000, or they used to, let's say, take 50, now it's 10. If they elect to do the PTE route through the state, then there's a way that they could still get that $50,000 reduction. But there's just several incremental steps that have to be done, and they have to have a business be able to even leverage it. Right? So there's a lot of hope by pretty much any homeowner in any high property value state that SALT cap does sunset this year, right? It also alleviate some of the unnecessary complications that you have to do to take advantage of the loophole in states like California with PTE. It's great work for accountants, right? Because then it's more billable time to do these extra steps, but it's not needed, right? So we're hoping that that does sunset this year. Another change was the estate and gift tax exemption. It used to be, I think, around 5 million or so. As of 2024, it is up to 13.6 million. So what happened with the TCGA, it effectively kind of doubled the exemption amount. That's a big number, and a lot of people ask, well, what does that even mean to me, Jeff? Do I have to pay estate and gift taxes? For most of us, no. Right? Most of us, at the time of our untimely demise, the value of our personal estate is usually going to be materially less than 13.6 million, or it's materially less than 5 million, but you never know. The reason why it's a big deal is because estate taxes are 40% plus. They're very stiff, right? And especially if you factor in the state and the federal side for those. Arguably, state and gift taxes are more than any other tax we could incur. Now, granted, it wouldn't be us personally paying for it. It would really be our beneficiaries that are burdened with that. Right? So the TCGA effectively doubled that exemption amount. So the way it works is, as long as the amount that you've gifted to other people plus the value of estate upon your passing is less than the exemption amount, then no estate gift taxes have to be paid. Right. So the question is whether or not it's going to revert back to the number it used to be pre-2018, or if they're going to keep it elevated like it is now. Another one, a big change was the corporate tax rate. It was, I believe, about 35%. It was brought down to 21. That's a significant decrease. Right? Imagine if all of our tax brackets all of a sudden just got, cut by 30% plus. It's unlikely, given the current administration, that they're gonna allow it to, they're gonna put it back up to 35%. But because of where things are at economically, and given some of the other things they're looking at doing, I would wager that the corporate tax rate probably needs to come up to some degree, despite the pushback on that happening. But we'll see what that is. I think there's going to be a lot of changes on the tax code are going to be occurring during the course of the year. They'll likely take effect January 1st, 2026. One other change that took effect for this year, there's a new 1099. So most people are probably familiar with 1099 miscellaneous or 1099 NEC, non-employee compensation. That's usually what we give to self-employed people. Or if you've ever have an interest-bearing account, you might get a 1099 INT, right, from the institution. Now there's going to be a new one, a 1099 DA. And it's specifically for digital asset reporting. Right? There's a lot of questions about how that will work, what it will actually report, right? Gains, losses, what inventory methodology, what realizable threshold, if any. Kind of like 1099 miss. It's usually $600 or more. So we'll see how that pans out for this year. But since it takes effect 2025, then that means that's what organizations and certain entities will be issuing to people that have digital assets in January 2026 for the 2025 year. Okay. There's some other changes in the works. I figured I'd focus on the TCJ sunsets because those are pretty significant and will impact a lot of people. And then the new 1099 that's rolling out. So sticking with the theme of digital assets, remember, if you have any and you did anything with them other than hold them, then chances are there's some taxable events that need to be reported. Right? When I first started up my firm in 2017, this is kind of right before crypto became a little bit more mainstream like it is now. It's also less complicated, right? There's no liquidity pools or reward protocols or anything else like that back then. All right, I don't think I had any validator clients or anything like that. And now you have all these other things happening in the crypto space. Right? But anyhow, there's a misunderstanding that if you had crypto and you traded it for a different crypto, a different coin, that doesn't really mean anything. It doesn't mean anything from a tax perspective until you actually cash it out. Fast forward, taxing authorities made it very clear that no, those are all taxable events and you have to report all of them. And I think most people seem to have that understanding now, but every now and then I still get some clients referred over to us that still are under the old misconception that they only have to report on the money that they take out. And keep in mind, it doesn't matter whether they lost money or not. Right? Let's say someone has a bunch of crypto, does a bunch of trading, coins for coins. They have $50,000 of capital gains. But then something happens in the market, and all of a sudden the value of all their cryptocurrency is only worth 40,000. Now let's say 10,000. Right? The tax on 50,000 of capital gains will usually be 10,000, right? Plus the state side, right? So their argument is, well, even if I sold all my crypto, I wouldn't have enough to pay the tax bill. That doesn't seem right. Well, the position for taxing authorities and IRS and FTB and others is, so what? If you chose to keep things in the market and keep gambling with the same money, that's on you, right? They see it more as almost kind of like as a gambling. Like the longer You decided to take your winnings and keep it in the pot, and then you lost those winnings. That's not on us. We still want to get our cut of the winnings that you did have access to that you chose not to cash out. And that's still the case now. Now, fortunately, I think for a lot of people that maybe have been in the space, crypto space, for a longer period of time, given the recent, the way the markets kind of ebbed and flow and bear versus bull, most people tend to be up and seem to be in a decent enough position to cover their taxes associated with their activity in the crypto space. When trading, there's two ways you taxed when it comes to crypto, or two different tax rates. Right? There's either the long-term capital gain tax rate, which caps out at 20%, nice number, right? Less than the corporate tax rate, which is 21, or ordinary income tax rates, which could go all the way up to high 30s. Yeah, so it can be substantially more. So if someone's in the crypto space, you're incentivized to be treated everything as much as possible long-term. For it to be deemed long-term, that means you have to hold the asset for a year or longer. Right? So if someone trades a coin for, let's say, Solana for BTC, for it to be deemed long-term, they would have needed to hold that Solana for a year or more. Right? Otherwise, it's deemed short-term capital gain, which is treated at ordinary income tax rates. Again, not preferential. If someone is mining, two things happen. Let's say someone mines 0.5 Bitcoin. Right? The 0.5 Bitcoin that they receive at the time they receive it is ordinary income. Right? I think it was almost someone giving you interest or something. But then the value of that coin is also your basis. So then when it's sold later on, there likely be a capital gain or capital loss. Over the recent years, almost 8 years now, right? The IRS has been increasing the number of notices and forms that they've been sending out to taxpayers as well as to entities like Coinbase, right? A few years back, this is pre-pandemic, they put a lot of taxpayers on notice with Forms 6173, essentially saying, hey, we know you're trading in digital assets. Make sure you're properly reporting. Right? That's all it was. It wasn't an audit. It wasn't an examination. It's just putting people on notice, a little fear-mongering to encourage them to be transparent and honest in their tax returns. Right? And I think it definitely helped, just given some of the calls I got after that. In addition to that, they've been subpoenaing documents and records from organizations like Coinbase and Crypto and .com and whatnot. And for those organizations to want to continue to operate under the U.S. To avoid certain other regulatory scrutiny, they're complying, right? They really have no choice. Over time, the regulations surrounding cryptocurrency is only going to continue to increase. It's not going to go away, right? Which means there's going to be more and more transparency from ecosystems, platforms that do anything in the crypto space to make sure that they don't get in trouble with the government, right? By making sure that they'll provide whatever they have about their customers, their clients, to the government, which means that anyone that's using any of these platforms, apps, ecosystems, institutions, will be on the hook for whatever they're doing on them and need to make sure that they're properly reporting. So this kind of goes back to the information matching concept, right? The 1099 that comes from someone, and then the self-employed person that should be reporting that 1099 income, right? They're going to be looking for similar things between taxpayers and what these organizations are reporting to the government. Now, there are several software platforms out there that can help individuals with figuring out what in the world did they make in terms of capital gains and losses. One challenge, though, or major shortcoming with virtually all these platforms is that they tend to overstate capital gains. because one of two reasons. One, a lot of individuals using these software tools don't really understand the implications of properly connecting and interpreting the data that's flowing into them. So let's say someone is using, Coinbase, Binance, Kraken, and they're also doing some things in DeFi, off chain, and then they try to put everything into one of these software platforms to figure out how much they have to report on their taxes. If they don't know how to use that platform and don't really understand the ins and outs between these different wallets and ecosystems, they'll usually misuse the software, which will result in reports that are not entirely accurate. Another issue is the software's generally misinterpreted transfers between between wallets, and they'll result in often things that have incorrect cost basis on reportable transactions. So the point is, if using any of those platforms, just keep that just kind of grain of salt that they may not be entirely accurate. And that's one of the reasons in the fine print, it's kind of funny. They essentially say, don't rely on the software, consult a professional, a tax professional. Right? It's their little disclaimatory language just to get them out of any sort of liability. Now talk about some tax strategies. These are some of the common low-hanging fruit options for people. The first one being contribute to a retirement plan. Whether it's pre-tax dollars or post-tax dollars, just maximize contributions to a retirement plan. It's kind of one of those things that's kind of a no-brainer, ways to kind of save on tax either now and or long-term. That works for pretty much everyone. Whether someone is, an employed person making $40,000 a year, or a self-employed person encroaching on retirement that's making $10 million a year, contribute to retirement plans. Right? It's an easy way to mitigate some tax exposure. Now, if on the latter end of that hypothetical spectrum I just shared, and self-employed person making $10 million a year, there's a lot of other opportunities, ways to save on tax that I'm not going to go into here. But there's pretty much a strong correlation between the dollar value of tax saving strategies and the volume of tax saving strategies of how much one makes, and those strategies, right? So someone that's has a complicated business structure, several different revenue streams, preferably some sort of cross-border activity, and we're in the millions or tens of millions a year. There's probably a lot of things that they could do to really mitigate their taxes. Whereas if someone that has a much more simple tax situation, there's fewer opportunities, unfortunately. If you are self-employed, though, make sure to write off all legitimate business deductions. Legitimate is the key word there. Right? A question sometimes comes up. Well, actually, it comes up a lot. Jeff, I have a business I just started last year. What all can I deduct? I want to deduct as much as possible. So that's great. Well, ultimately, it's really whatever is customary and necessary that's directly related to the revenue of the business. Like, well, what is that? Well, then I asked them to explain to me, okay, what kind of expenses are you incurring directly related to the generation of your revenue streams, whatever that is, right? Whether you're consulting, you're doing AV installations, it really doesn't matter what, right? But it needs to be connected with the business. So if it's connected to the business and it is customary and reasonable, then yeah, definitely deduct it, right? What's not reasonable is things that are really more perquisite, right, and not really attributable to the business, or don't, might be a little bit of a stretch to attribute to the business. For example, I was working on a law firm partnership dispute a couple of years ago, and the partners, they work 50-50, and they're suing each other related to, one partner was taking out more financial benefit than the other. And the partner that was taking out, I was hired by the partner that was making less money. The partner that was getting a lot more financial benefit from the business was running all sorts of personal expenses to the business, such as personal nanny. Well, last I checked, a nanny is not a necessary and customary business deduction for a law firm. Was paying a ghostwriter for a book that it claimed was going to be marketing for the firm, but when you looked at the materials for all the marketing, is completely about her, and it was nothing to do with any of their clients or the type of legal work that they did. Right. So another example where it wasn't really necessary for the business. It was unrelated to their business revenues, and therefore not a legitimate business deduction. And I usually tell clients, if you're kind of on the fence of whether or not something is a legitimate business deduction, just close your eyes and picture yourself in a room with two IRS auditors, and they're asking you to explain in detail, underneath penalty of perjury, how and why is XYZ expense legitimate and connected to the business. And if you feel you could give a realistic, well-substantiated, and acceptable answer to that, and by all means, go ahead, deduct it. Right? A couple other things to help mitigate taxes, think of is specialty credits like for solar and electric vehicles. For those that have taken advantage before the end of the year, congrats, right? Because the credits are worth further reduced this year. And actually, that's been kind of the theme for the last several years now for solar and AVs. Like the credits, the tax credits for them have been diminishing over time, which makes sense, right? Because they've also become increasingly popular and common and also less expensive, right? Another great way to mitigate taxes is to itemize your deductions. And one of the best ways for that to make sense financially is to have a personal residence, right? It doesn't make sense to itemize deductions if the standard deduction is more, right? You obviously want to take whichever one's bigger. And usually for itemized deductions to be bigger, either you need to have a personal residence and or significant health-related cost. But usually personal residence is the common inroad for doing a Schedule A. And also, hopefully, if the SALT cap gets sunsetted this year and the property value cap goes up this year, then it'll be even more beneficial to itemize 2026 and forward. Here's some other tax strategies, but we'll skip past these. Just know that you're always welcome to reach out to me if any questions on on another strategy you heard about, right? Especially if you have a business. Now, I want to focus the last and key takeaway here, right, is be very mindful of the things you Google and see on Reddit boards and blogs. There's a lot of misinformation out there as it relates to taxes. I sense that for a lot of clients, there's always this lingering feeling in the back of their mind that they're missing out on a deduction, right? Or there's some strategy out there that will take their tax rate from 22% to 5%. And they just know it exists, right? Because they read about it and they hear about such things and they feel like they're missing out. A lot of FOMO. Right? A lot of that stuff, it requires context for it to make sense. Yes, there are some really interesting strategies out there, but usually you have to have a very, very unique and complex tax situation to take advantage of some of those things, or for the cost versus benefits of those to make sense for you. Right? Consulting with a professional can help you navigate some of those situations and explain why or why not certain strategies would work for you. Help save money on taxes, of course. Help mitigate chances of an audit or examination. And if you have a business, of course, paying a professional accountant their fees is a legitimate business deduction. And then on a long-term perspective, can help with some tax planning strategies. With that, I'll open up if there's any questions or anything else you guys want me to go back and get into a little bit further. I think we have about 5 minutes left. I'm happy to go over because we started about a little late.